Evan Lucas from InvestSMART is our next guest on the program. Evan, I wanted to talk about the big news today. I'm sure it's the talk of everyone in the finance world, a new tech listing in Australia. So it's our NASDAQ, which I assume means it's a hell of a lot smaller. What's the significance of this?
Yeah, it is, Tom. That's the perfect way to look at it. It is a heck of a lot smaller. And look, it's significant from several parts in terms of how you look at it. It's going to be a bumpy ride to sort of start off. And I think that needs to be what most people look at this from. You need to go in eyes wide open. It is dominated by what we refer to in our world as the WAAAX stocks. So that's WiseTech, Altium, Afterpay, and all of you, I'm sure, out there know what that is, Appen, and also Xero. You then have other players in there as well, like REA Group, like something like car sales, etc. The way and looking at it longer term is that it is exciting. And the reason I say that is that if you look at something like biomedical and bio sort of technology stocks, they are screaming out places to find funding. And most of them end up in the US. And the only issue with the US for them is that the cost of doing their kind of business over in the US is about 10 times more expensive than it is here in Australia. And that is what they see this as an exciting sort of spot to be, why the listing could be very interesting over the next several decades, because it will go over that period. They will make it work, whether or not it has a bumpy birth or not. It is a way of actually providing a new place in the world for funding. It also provides Australian investors with something new and exciting, but it could actually be quite an attraction for those firms that do want to find a cheaper place to do high-end manufacturing, which is particularly things like biomedical, and that's also what it's clearly aimed at.
And Evan, we've seen the Aussie dollar has just been performing incredibly poorly, 11-year low.
Yeah, it is, and it's not slowing down. And that's the interesting thing around all this. You saw it drop 0.9% in the last 24 hours. And considering that we were at an 11-year low, that's a significant movement. And it's on the back of the idea now that the RBA is clearly in play. Yesterday's employment numbers, it depends on who you ask, on how you look at them. We're either sort of nil-sum game or getting slightly worse. The interesting thing really to take out of is that full-time workers are actually working ever so slightly less. Part-time workers are working more, and therefore we're not seeing any wage growth at all. But overall, the wage sort of growth scenario falls into the biggest problem, which is that for every one person employed, about 1.2 people come back into the market. And that's where this unemployment rate tick-up is happening. 5.3% means the RBA is likely to cut rates. It's going to put even more pressure downward on that overall scenario and why the Aussie is going the way it is. There is growing signs that it could go to actually the lowest we've seen since way back in 2000 of around about 60 cents by December if it keeps up with the current sort of trajectory it's going.
So you're talking, what, lower than GFC lows that it plummeted?
Yep.
Even though the economy is not doing any of those things, and you can look at the housing market and the ASX is hitting record highs just as the dollars are plummeting so much lower. Is it just around the jobs and RBA? Is it just such a bigger guide?
It's a whole it's a whole range of things, Tom. And look, the GFC is slightly different in terms of why I say that is that during the GFC, we were, as a nation, were supported by China, and the fact that the mining boom was still happening. Yes, they experienced it. We didn't slow down. The other thing that you've got to look at with FX, there are so many things that play into it, and rates, so things like fixed interest rates, particularly sovereign bond rates, what happened? Try not to go get too deep into it. You've got to also look at it from the point of view that when we talk about the Aussie dollar, there's two sides to it. So it's the Aussie to the US dollar. And that's what you've got to also remember is that the US economy is actually stronger than ours. The other thing is that their 10-year bond is higher than ours in terms of the rate that you're getting from it. And when you see the differential that we have between the Australian 10-year and the US 10-year, the last time it was as negative as it was back in 1981. So you've got to go all the way back then. It's 121 basis points, so 1.1% is what it got differential in that space. It's currently sitting around about 70, minus 70 basis points. That alone should actually see outflows. Therefore, people have to sell Aussie dollars by US dollars, and that's what's forcing the currency down. And that's going to continue because our bank is cutting rates. Their central bank, although they did cut rates, is likely to hold rates for the rest of the year. That's what the market's also reacting to and why our currency is going lower.